theory was first introduced by Charles Dow, who was the founder of Dow Jones and Company and the first editor of the Wall Street Journal. This theory is based on the many editorials he had written between the years of 1900 until 1902. The Dow theory is a financial theory that says the market is in an upward trend if one of its average, example industrials or transportation, advances above a previous important high and is accompanied or followed by a similar advance in the other. For example, if the Dow Jones Industrial Average climbs to an intermediate high, the Dow Jones Transportation Average is expected to follow suit within a reasonable period of time. In Dow theory, the market is said to have three movements of waves, all going at the same time. The first or the primary movement is a broad movement of a bull or bear market that lasts several years. Next is the secondary movement, which lasts from several weeks to several months. This secondary wave occurs within the primary wave. The third or the tertiary movement is the random day-to-day movement. What is moving average? Moving average is a simple technical analysis tool. Moving average are usually calculated to identify the trend direction of the stock or to determine its support and resistance levels. It is a trend following or lagging indicator because it is based on past fact. A moving average is obtained by adding a series of closing prices of the stock for a number of days and dividing the sum of prices by this number of days. Moving average for 10 days, 30 days, 180 days, 200 days may be used. There are three types of moving average used. First, simple moving average is an arithmetic moving average calculated by adding recent price and then dividing that figure by the number of time periods in the calculation. For example, one could add the closing price of a security for a number of time periods and then divide this total by that same number of periods. Short-term average respond quickly to change in the price of the underlying security, while long-term average are slower to react. Second, weighted moving average, a technical indicator that assigns a greater weighting to the most recent data points and less weighting to data points in the distant past. The traders use this average to generate trade direction and make a buy or sell decision. Traders use the weighted average tool to generate trade signal. For example, when the price action moves towards or above the weighted moving average, the signal can be an indication to exit a trade. However, if the price action dips near or just below the weighted moving average, it can be an indication of a favorable time to enter a trade. Exponential moving average is a technical chart indicator that tracks the price of an investment like a stock or commodity over exponential moving average. Reduce the lag by applying more weight to recent price. The weighting applied to the most recent price depends on the number of periods in the moving average. This average different from simple moving average in that a given days. This average calculation depends on the calculation for all the days prior to that day. What is breadth market? Market breadth or breadth of market refers to a set of technical indicators that evaluate the price advancement and decline of a given stock. In market breadth represents the total number of stocks that are increasing in price as opposed to the numbers of stocks that are undergoing a decline in their price. The stock belongs to a particular index on a stock exchange. Stock index is a bundle of securities. The price movement of an index suggests the market sentiment of investors for the entire stock exchange. Traders and investors use market price in order to assess the index overall. Market price can be reliable, if not an accurate indicator of an upcoming price rise in the index. Similarly, it can also provide early warning signs for a What is support and resistance? Support and resistance is one of the most widely followed technical analysis technique in the financial market. Support describes a price level where a downtrend occurs due to demand for an asset increasing, while resistance refers to a level where an uptrend reverses as a sell-off happens. It is a simple method to analyze a chart quickly to determine 3 points of interest to a trader. First, the direction of the market. Second, timing and entry in the market. Third, establishing points to exit the market at either a profit or loss. Support levels are usually below the current price, but it is not uncommon for a security to trade at or near support. As technical analysis is not an exact science setting, precise support levels can often be difficult. In addition, price movements can be volatile and briefly dip below support. For example, it does not seem logical to consider a support level broken if the price closed and 8 below the established support level. Resistance levels are usually above the current price, but it is not uncommon for a security to trade at or near resistance. In addition, price movements can be volatile and rise above resistance briefly. Sometimes it does not seem logical to consider a resistance level broker if the price closes 1/8 above the established resistance level. What is trading volume? Trading volume is a measure of how much of a given financial asset has traded in a period of time. For stocks, volume is measured in the number of shares traded, and for futures and options, it is based on how many contracts have changed hands. The numbers and other indicators that use volume data are often provided with online charts. Looking at volume patterns over time can help get a sense of the strength or conviction behind advance and declines in specific stocks and entire markets. The same is true for options traders, as trading volume is an indicator of an option's current interest. In fact, volume plays an important role in technical analysis and features prominently among some key technical indicators.